Hi guys, and welcome to episode 3 of the Market Structure Masterclass. So this episode is going to be talking about liquidity concepts, all things liquidity, how to trade liquidity. We'll get into the internal topics in a second. I highly recommend that you look over episode 1 and 2 before you come into episode 3, because the way we've done it is that we have structured it so you are learning as you go along, and each episode leads on to the next one. So we talk about some concepts from episode 1 and 2 in episode 3, where you would need to understand what we are talking about to be able to trade into liquidity concepts. So let's get into it. So what is, in the first part, we're going to talk about what is liquidity, moving on to types of liquidity, inducement, talking about swing failure patterns, a bit of an extended section talking about just liquidity tips and trading different types of liquidity patterns, and then right at the end we talk about some liquidity concepts. So part 1, what is liquidity? So liquidity is relating to the degree at which a market, that can be an asset or a security, can be quickly bought or sold in that given market without affecting the asset's price. Having good liquidity in a market is very important. With better liquidity usually comes less risk. With lower liquidity comes the chance that you may not be able to buy or sell your position in that small window you may have wanted to. Okay, you have high volatile moves in price action. You're trying to sell your position with price dumping, so your long price is dumping, you have highly volatile movements. That asset you are currently trading has low liquidity. You will struggle to get filled on your position. You're gonna get slippage. So assets with high liquidity order books allow you to rely on someone being at the other end of your order. Okay, like I spoke of, you want, like here we have, you need equal supply and demand. When one exceeds the other, we have a liquid moves, sharp aggressive price action in either direction, high volatility in the market, but low liquidity becomes a problem for you when you're trying to close your position. Like I just said, if you're trying to sell a large position and there is no buyers interested there, you're going to struggle to get the full the full fill on that position, especially in highly volatile markets. So liquidity in an asset is never fixed to a certain amount. It can fluctuate from high liquidity to low liquidity within days, especially crypto. It depends on the volume for the asset during the day. For example, you could be trading something one day and it's fairly low liquidity, and the next day, for whatever reason, there's news in that asset. So a crypto has news, and now you have all this volume coming in. You're going to be able to buy and sell positions a lot easier. So this page is in credit to Adam's blog. The link's down here. If you go check it out, there's a really good article, and this was just a little section I took from it because I thought it was a good fit. So there's 4 different types of liquidity in the market. You have low liquidity and high volume, which gives high market volatility and large market movements. Okay, so things like Bitcoin can be, there's fairly low liquidity with large participants, so you have high market volatility and large market movements. High liquidity and high volume, normal market behavior. High liquidity and low volume, low market volatility and small market movements, and also low liquidity and low volume usually is normal market behavior. Okay, so high liquidity and high volume is usually things like S&P 500. So just a little summary on the first part. For the most part, good liquidity means that the asset can be sold or distributed without gaining any loss or extremely high fees, or moving the asset price by a certain percentage. You're trying to sell a large portion of your position. The liquidity is not there for that. Obviously, you're going to be having to move price a lot for you to get filled. Okay, you need supply and demand to be equal. Large liquidity in the order block. Good liquidity means that there's large liquidity in the order block or order book. For example, the S&P 500, really doesn't have highly volatile PA. It does sometimes, but for the most part, not a lot. Low liquidity in a market is, as you guessed, the opposite. It means that an asset cannot be sold in large portions, depending on the volume itself in the market without moving the price by a certain percentage or paying a large amount of fees. Low liquidity in the order book is, crypto shitcoins with low market cap. So I would recommend going back and reading this section, completely understanding, what liquidity is, what market you are trading. Knowing what market you are trading is very important because it also depends on the size you can trade for that specific asset. Liquidity, this is what brings us on to now our liquidity concepts and the episode itself, what the episode is talking about. So liquidity can be used more to talk more about than just how much volatility there will be or how much buy power it would take to move price by a certain amount. It is also used in trading as a name to areas where new existing orders will reside. So for example, the example we have below. So what your target is what you can already see in the market. Okay, a willingness to go higher or lower based off where liquidity may be. You can see the swing high in the market, this high here, and then moved lower from there to create a swing low. Okay, so we have this structure here. The way you need to see this high is that there is going to be buy stops or buy liquidity above that high. Okay, so we can call this buy side liquidity. Similar to as if we look at the clean lows down here, we view them as sell stops or sell side liquidity below these clean lows. Okay, so this is where sellers are looking to grab liquidity before a move up, and this is where buyers are looking to grab liquidity before a move down. So the fundamental concept of liquidity is that it's going to be above old highs and below old lows. Okay, so the market loves to target the same areas over and over again, like we saw in this angle. So this chart here, we have a low and a high. The market loves to sweep these swing points before deciding which way it's going to trend. Okay, so market loves to target the same levels, raiding previous highs like here and raiding previous lows. Once you start to target these areas for your trade entries, you will understand price action a lot more. So 2 examples here. What we have here is price making, not necessarily clean structure, but we've got these swing high points, and they're not, at no point is price coming up to retest them. It's just a constant downtrend. Eventually what you see here is price coming up to take all of these stops above these highs. So we have sell stops and sell orders above here. So anyone looking to short, anyone getting short down here, the chances are they're going to have their stops above here. Price then has this impulsive move to the upside, grabs all of these orders, all of these orders that are building here, any sell orders, most likely stops them out, grabs new sell orders, and then dumps it. Along with grabbing new sell orders, we're going to have buys up here. We're going to have people trying to play the breakout. So they've probably played the breakout trade here. Then what they do, these guys that are buying up here are now forced to close once we start, tucking back below here, and it then adds more fuel to downside. And then the same thing is happening here on this side. So we've got a swing high and a swing low. Price sweeps this swing low, and we see price move to the opposite direction. The same up here, we have orders above here. Price sweeps this high, and we start to trend lower. So what we're looking at here is buy side liquidity and sell side liquidity. We get onto this more later. part 2 of our episode 3, talking about types of liquidity. So we're going to be talking about structured liquidity, equal liquidity, which is like equal lows, equal highs, and trend liquidity. Range liquidity, you know, fairly self-explanatory. Talked about ranges in previous episodes, just the liquidity that may rest above / below the range. So, like I just said, 4 types of structured liquidity pockets known to the market structured traders that we can label. So they are highlighted by, as I talked of in part 1, buy side liquidity and sell side liquidity. They're used to plot where the liquidity is resting. If you follow a lot of PA traders on Twitter or Discord or whatever, you see that they have BSL and SSL on their charts. This is the meaning behind them, where liquidity may be resting, where the seller liquidity may be resting, where the buy side liquidity is resting. So buy side liquidity is liquidity that rests above the current price of an asset, okay, and the sell side liquidity is the liquidity that rests below the current price of the asset. Both of these can be found above / below key swing points of the chart, okay, and that's what I like to say is you find it above the key swing points on a chart. So yeah, this part 2 is talking about the 4 main types of structural liquidity pockets, and they are trending liquidity, ranging liquidity, structured liquidity, and equal liquidity. So first we're going to talk about the structured liquidity. Okay, so the structured liquidity is found when the market is forming like clean price action. So we have in an uptrend we see higher highs and higher lows, as talked about in episode 1. Sell side liquidity will be found under the key swing low points. So we have higher high and higher low structure. We find the sell side liquidity tucked below the swing low point, so the low that led to a new high, okay, and this is known as your market structure. The buy side liquidity is above your key swing points, key swing high points, sorry, the last swing high that led to a new low. So for example, we're in a clean downtrend here. We have your lows that lead to a high, that this high leads to a lower low. The high that led to a lower low, you're going to have resting buy side liquidity above, okay, so you're going to have people that have shorted, you're going to have stops above here. So we're going to call it buy side liquidity. It's areas where buyers will target liquidity or want to take out liquidity. So studying previous episodes, you should know this is also your current market structure when in a downtrend. Okay, like I just said. So a couple examples here of structured liquidity and what you can see. So up here we have the H4 chart of BTC. We have lows into our highs, into a higher low, into a high high, high low, high high, okay, making high highs and high lows, trending up, forming sell side liquidity, okay, so your sell side liquidity is sat below these lows here. So you have below this low, and below this low, as I've labeled here, okay. The liquidity is swept of the sell side liquidity is swept, and then you see what happens with price after this, okay. And sometimes price does need to have this sweep to see these sort of moves. Okay, so you see we've gone from making fairly clean high lows, high highs into high lows, and then this low is broken here. It's internal structure here. This is all internal structure because this was the last high that led the last low that led to a new high. Okay, so until this is broken or this high is taken, this is our structure point. Okay, we've talked about this a lot in the first 2 episodes. Okay, so we have our internal structure, and then what we see with our internal structure here is that this is obviously a weak low. This low did not lead to a new high, so the chances are this is going to want to keep trending down. It keeps making lower lows until we grab this sell side liquidity here. Until we grab this, then price wants to trend, then we can see the trend. We have the liquidity now, we grab the sell side liquidity and then we trend. Before we grab this liquidity, you can see price was just selling off. There was no real interest in buyers. So the second is the Bitcoin M30 chart. Okay, this is an example of grabbing buy side liquidity. Price is making lower lows and lower highs, trending down with the buy side liquidity above. So we have buy side liquidity above here, you know, as labeled here. This was like the first example I sent in part 1. You know, we have almost like a trend. Price breaks out. We grab the buy side liquidity here. We trap, we trap breakout traders. We take some short stop losses, probably from all these guys who are trying to short. You know, in here we grab all their stops. Price then cuts back below these highs. You have all these breakout traders who are now trapped, close, and we force to move lower. So when you have, you know, this sort of structure, you're looking for buy side liquidity above, and this is what these are the moves you're looking to try and get short on when the buy side liquidity is above. When these highs, you know, when these structured highs are just they're not getting taken out, you know, there's no sweeps of these highs. It's just constant selling off. So now we talk about equal liquidity. So equal liquidity, also known as equal highs and equal lows, is one of my favorite places to look for liquidity sweeps, especially trading. They indicate that you have possibly 2 times the amount of orders built up below them, other than when you're trading structured liquidity. It's just usually, you know, like the 1 swing low, and now we have 2 swing lows or swing highs. And it doesn't just have to be 2, it can be 2 or more points of liquidity. Your lows also don't have to be exactly equal. They can be slightly off piece as long as the second low is not the first one. So what I mean by that is, if price is sort of coming down like this, but it kind of bounces just above, these are still equal lows to me. Okay, these still are equal lows. It doesn't have to be, you know, exactly the same like that. Okay, it can be a little bit off piece. We can still call them equal lows. So sell side liquidity rests below equal lows, and buy side liquidity rests above equal highs. 2 examples of equal liquidity here. So the top example is equal lows on BTC M30 chart. You can see what happens when price, you know, sweeps this. We have equal lows. We have resting liquidity all below here. Okay, price sweeps below equal lows. What we do now is we trap sellers. So sellers trying to play the breakdown. They're now trapped down here. We have all of these buy stops below here. We probably have people that were trying to buy what is known as support. Okay, you know, we have people buying support. They think, okay, we bounced here, here, here. Okay, we're going to bounce a 4th time. We take all their stops below here. Price comes up, we reclaim, and you see then what happens. We have this impulsive move. We take out all of this imbalance. We take out all this buy side liquidity now. Okay, you know, this is all built buy side liquidity up here. And then example below is ETH H2 chart. Okay, equal highs, and again you see what happens. We have equal highs here, equal highs here. Price sweeps equal highs, takes buy side liquidity, and then you see the reaction from this. Okay, equal lows and highs can be seen as good places to target as take profit areas, and also places where you're looking to get long at / short depending on the direction once they've been swept. Okay, so they, you know, if you are looking to get short, say we have so you have price action, you have a set of equal lows here, but okay, imagine these equal lows, forget that. You have equal lows, price is coming up, and then you have, you know, you have the market structure break, and we're looking to get short. These equal lows are a nice target down here. This is where you want to TP, because you know you're going to have sell side liquidity down here. So we're going to want to target the equal lows. Once these are swept, we take profit, and then price will probably bounce the other direction. Okay. So for example, if I'm looking for a high conviction swing long or short here, so this is current BTC PA at this current time, I would look to wait until either side of these current equal highs and lows have been swept. So we have the highs, we have equal lows. If I'm looking for a high conviction trade right now, either direction, I'm going to wait for these equal highs to be swept or these equal lows to be swept. Okay, I'm going to buy down here to target these equal highs, or I'm going to sell up here to target these equal lows. If price deviates back inside, then you know we have failed the breaking up and down. We can look to enter position. Based on the fact we swept liquidity, there was no interest for players to continue to that set direction. Okay, so right now it's fairly hard to take a long knowing that you have this sell side liquidity below, but if we sweep this and we reclaim, we're thinking, okay, we have now all this buy side liquidity above here, we sweep down here, we buy the reclaim, we can target this buy side liquidity. Probably what we do here, we sweep the buy side liquidity and then we're going to trend back down again. Just some more examples here of equal highs and lows being swept and how to trade them. They're some of the best setups you can trade. Okay, so we have equal lows, price sweeps, reclaims, and we trend. Okay, equal lows, like I said, they don't have to be exactly the same, they can be slightly off piece. Equal lows, price sweeps, we reclaim, and we trend. Okay, this is also an over under. I talk about over unders a lot. It's when you have like a support, a bounce, sweep. It's like a head and shoulders almost. Okay, and usually, and even more so, these are better because this has like equal lows here, and then example of equal highs, price has this big wick through, traps a bunch of traders, takes a load of stops, deviates back inside, and then we trend lower to fill all of this imbalance down here. So this is an example of an equal low raid into demand. So we have demand here, continuation demand down here. So we have demand here, and then you can see how price has just got all of these lows set above the demand. We have equal lows is swept. You take your, you wait for your reversal, or you wait for your reversal and you buy this order block here and long here and target buy side liquidity, or you buy the sweep into the demand on the first tap. Another example here of, so here we have a example of equal highs raid into supply. So we have equal highs with supply here before it broke structure. So standard procedure, standard setup, break of structure here, supply, equal highs below supply, price raids equal highs, and then we sell off from there. Same example, stop above the high. So now we'll be talking about trend liquidity. Trend liquidity, really, it's not too far off structured liquidity in the idea that you have either swing highs or swing lows that make up your buy side liquidity or sell side liquidity, with resting fresh liquidity above or below. Only this time is that you want to see a clear trend formation in price following a set higher low or lower high formation. Doesn't have to be like a market structure. It doesn't have to be perfect, so you don't have to see exact lows into new high, into low, into new high. It can be like this, so then we've got sell side liquidity under here, because it's like the trend. This is your trend liquidity, and vice versa for your highs. It'd be like a buy side liquidity like here, this. So what I was trying to say here, it just needs to be a directional trend of lower highs or higher lows making the trend line liquidity. So a few examples here of trend line liquidity. So top left is ETH H4 chart, and you can see how this parabola is creating a lot of buy side liquidity. None of these highs are really being retested or taken out at all in this trend. Okay, there's no attempt for bulls to try and take some shorts out and before selling off to the downside, or even push higher than this sort of range we're in here. So at no point was the buy side liquidity really targeted, so it's showing weakness from bulls. Whereas on the top right here is M15 PA from BTC, very similar. You have this buy side liquidity here, and eventually price breaks this trend. Okay, and you see what I mean by these highs don't have to lead to new lows. So this high doesn't lead to a new low. This high doesn't lead to a new low. This high does lead to a new low, and this high starts the trend. So it's just you're focusing on the highs more than the structured trend and the structured liquidity. And then what you're looking for is to sweep the buy side liquidity, to come back down into the trend, and then it will continue. Example in the bottom left is ETH H4. You can see clear trend we have here. Eventually price breaks the trend, we sweep, probably traps a bunch of traders trying to play the trend, trying to play the breakdown, gets back up, reclaims, and then we see a continuation in trend. Bottom right is H1 BTC. Again, you can see a similar thing. We see a trend, price sweeps, reclaims the trend, tests it again, and then we continue. So all this is doing is trapping breakdown traders, taking stops from people who are longing all of this, who may be longing a support here, but really it's just like trend line. Take the sweep, back, reclaim, and trend. And you will see this a lot with PA once you start to notice it. Trend line liquidity example here. So sometimes, like I said, you see obvious trend line breakout. There's a favorable type of trading for a lot of retail. Myself, when I first started trading, I was using breakouts. I was trading the breakouts. I was longing here, and I was putting my stop down here somewhere. Whereas now, if we're trading market structure, we're looking to trade and balance the order block. So what we have here is price breaking out. We have people longing here. They probably have their stop below this trend line. Comes down. It takes our order block that we most likely would have been trading here. Okay, this is where we would have been looking to long. Takes the stop. Then we get our long, and then position goes. Breakout traders will stop, but the real move happens after that. And of course, sometimes the breakout will continue and you do not get a retest, but it's part of having a set strategy, sticking with your strategy and believing in what you want to trade. Okay, not trading the breakout and you're waiting for that sell-off to come back down to test the point of imbalance. So this is called trend line liquidity. We fill the order block imbalance, and then the real move happens, like I just said. So now to do a little bit of talking about range liquidity. So range liquidity is very similar to equal liquidity, as both can be found in a range. Equal highs, most likely you can find them in some sort of ranging environment. Range liquidity forming at the range highs and the range lows, also forming equal highs and equal lows. We've already spoken about finding range in previous episodes, so finding where the liquidity is resting in a range should be fairly self-explanatory. Range lows, if price starts ranging, then sell side liquidity will be below these lows. If price starts ranging, then buy side liquidity is going to be sat above the highs. Trading the sweep of sell side liquidity and buy side liquidity in a range is, in my opinion, along with it ties in with the equal liquidity, equal lows and equal highs, some of my favorite entries. Buying or selling where others are closing positions because they're concerned about the breakdown or breakout. So, we'd be looking for this to come down, sweep these lows, and then I would be looking to long in here or long the reclaim of the range low, and then we target the range highs. So yeah, I already spoke about this. It's very similar to equal highs and lows. Obviously, the more touches you have at either the range highs or range lows, the more orders you will have building above or below. In this case, price swept the sell side liquidity before extending higher, and you can see the range low here, 1, 2, 3, 4, 4 sets of lows. Price eventually sweeps. We do have another little sweep after this, reclaims, and then we trend. And of course, buy side liquidity we have above here, but at note, it was swept here and didn't really give a good reaction. Prices sat just consolidating below the range highs, most likely gonna push higher. Another example here of the Bitcoin H1, small range forming, range lows, sell side liquidity, you can see the lows building, swept, reclaimed, we trend. Okay, buy side liquidity, range highs, I guess you could say this could be range highs here as well or something. This was a sweep and this was the range highs. It gave a little reaction, but for the most part, we continue to trend this way. And these are what you're looking for. These little sweeps of range lows, and then you buy the reclaim. Bitcoin M30 chart, range forming here with buy side liquidity and sell side liquidity being swept. Trading the sweeps of the range are some of the best trades you can take with easy invalidation. Range lows, sweeps, range high, sweeps, trends the other way, and then what you want to do, you want to try and tie these sweeps in with reversal setups that we have talked about a lot. Right, part 3, we'll be talking about inducement. To go over what inducement actually is, types of inducement, and of course trading inducement. So inducement is found resting above or below points of interest. These points of interest can be fair value gaps, order blocks, or even both at the same time. Inducement tends to be an internal swing high or swing low that almost front runs your point of interest, thus marking that high/low as inducement. So you have point of interest, you have your order block, price almost looks like it front runs the order block, and this is then known as inducement in front of your order block. So inducement can be used as confluence to your trade execution because, as we have just spoken about throughout the first 2 parts, is that we now have fresh liquidity resting above/below inducement. So what we're using as more fuel for the entry. So now what we're seeing this is as buy side liquidity. We have a structured high with buy side liquidity below a point of interest. So this is adding more fuel to the entry if we are to look to get short here to then sell off lower. So inducement does not just have to have one swing high or one swing low that we know it as structured liquidity. You can have inducement that can be seen as several equal highs or lows near the point of interest. So like we spoke of in part 2 about the different types of structured liquidity you can get, the 4 different types. We can see them as equal highs and lows, or trend liquidity above or below the point of interest. So in this example here, we have trending inducement. Let's change this to black. So we have trending inducement. So what we have is our highs making this trend. Price comes up to sweep the buy side liquidity and inducement into the point of interest. We take our short with the stop above the high, and then we look to target sell side liquidity down here. Equal highs, we have our equal highs, inducement buy side liquidity. Same again, price comes up, and then we're looking to target sell side liquidity. Same for equal, standard inducement, just structure inducement. Price comes up, we have this reversal, the order block, and then we have inducement above point of interest. And equal lows, again the same, inducement, sell side liquidity, price then trends. And it doesn't always have to be reversal. We can also have it as continuation order blocks. So like we've spoken of before, when you have continuation, so we have say the break of structure here and an order block down here, price comes and front runs this order block in continuation, that can still be inducement here. Okay, it doesn't just have to be the standard reversal, the reversal PA. It can be also continuation, so it can be rally base rally or drop base rally. You know, we spoke of this in episode 2. So you know, inducement can be above any point of interest, a fair value gap, point of interest, sorry, order block. It's all your point of interest, and it will add fuel to your entry. So a few examples here of trading inducement. So we start with our standard reversal play, you know, drop, base, rally. So we find our point of interest. So we have our M5 point of interest. This was the demand that led to the change of structure. We have the sweep. So now we're looking for price to return to fill M5 imbalance and order block. You know, our standard setup. Price comes down, and you can just see just about misses our order block. Okay, long as it maybe getting too aggressive too early. Either way, we see this as inducement for the order block and still looking to take the entry down here if price comes back round. So, you know, we're still looking to get a fill on our order block. We still trust that price is going to want to fill this demand. So price comes back towards the same low and bounces just above, now leaving equal lows. Okay, so we have inducement, sell-side liquidity, and now equal lows. Okay, so now what we're thinking is, how much liquidity do we have sat below here? How much is in here? Okay, we're expecting a decent reaction now. So still targeting the same entry. Okay. Finally, we get the sweep. We have this buy side liquidity. We have this trend. So we have all of this liquidity we want to target. So we have buy side liquidity. Buy side liquidity above here. We have this trend, the trend liquidity, and then we're getting long. Okay, we get our sweep, we're getting long. You know, obviously we can wait for the change of structure if we want to, but given we have the equal lows, we have this order block, this cluster, I'm expecting a good reaction here. I'm expecting this to bounce very well. And then this is what we see, you know, great reaction for the order block, target hit, took out the buy side liquidity and TP full position at our target. And you can see here, works the same way, like I said, you know, equal lows, sweep, reclaim, trend. Okay, so it can be seen as, it can be used in many different ways. You know, the equal lows, you can just trade them as equal lows, or you can trade them as the reversal setup. Example 2, looking at BTC 10-minute time frame, targeting our sell side liquidity. We talk about these lows later on towards the end of the episode in part 5. So targeting sell side liquidity below after seeing price make a clean reversal on the M10. We're looking to get filled at M10 order block. Okay, we have fair value gap here. So after market structure breaks, we have M5 confirmation, price moves back towards fair value gap and order block, filling the fair value gap here, but we missed the order block. Okay, we're front run. Now we have inducement. So what we have here, we have people thinking, oh, I've missed my entry, this isn't going to fill me. So what people do, they start to get in their trade early, don't they? They start to get FOMO. So now what we're looking to do is to short the sweep of inducement high and have our stop above the order block. So inducement swept, order block and fair value gap filled. Take our short on the order block with a stop above the high. Again, expecting a fairly nice reaction here from the inducement. As always, you could be waiting for a break of structure. So you could be waiting for this low to get taken and then you could say, okay, we have our break of structure, and then we can get short here to target lower. Or if you're fairly confident in your trade, you can take it straight away. And you see the reaction we have. Great reaction from here, sell off all the way into the sell side liquidity I was targeting, full TP of the trade and move on to the next one. So this is a really nice example, especially when you have, you know, this swing failure pattern, which we also get onto later in the episode. We have a sweep into the change of structure and then the order block. Example 3, this one would have taken a while to do it step by step, so we've just sort of, I've just sort of done it all on one chart. Bitcoin M30 with H1 order block. So this is our H1 order block down here. We're looking at M30 time frame right now. Change of structure. We have this M30 order block untapped with M30 fair value gap. So what you have looking at here is you're thinking, oh, so we've just front run this order block. That's it. You know, I'm not going to get filled on this. I was waiting for my full entry. I was waiting for the FVG to fill. I was waiting for the order block to fill. We have this inducement. We have these lows. Okay, before this impulsive move to the upside. Inducement. Again, we have this another low that was almost like this equal low. So now what we have is trend lows, inducement, equal lows, fair value gap, H1 order block. You know, in this area, we have so much untapped liquidity still that we need to take. We have all these stop losses. We probably have all these people trying to play the breakdown. And above, we have all this untapped buy side liquidity. All of these highs that haven't been swept yet. So this is the perfect setup. Come in, great reaction from the order block. Okay, you can say, you can buy the reclaim of this low, reclaims, and look at the reaction we see. Takes out all of this buy side liquidity. So this is a really nice example, actually. Really like this example. It's your perfect idea of a reversal setup and inducement setup with just so much liquidity. Part 4 of liquidity concepts, talking about swing failure patterns. I was gonna put this in a later episode, but I think this this is definitely something people struggle with or trade incorrectly. Also, it's a swing failure pattern. You're swinging for liquidity. It's a liquidity pattern for taking stop losses and faking breakouts and things like that. So we'll talk about it more in later episodes, but I thought I'd do a little section on it in episode 3 anyway. So we're going to talk about swing failure patterns, the validity of an SFP, and also obviously trading the swing failure pattern. So an SFP is actually known for being an evil market maker strategy for filling their own positions. A scam move to grab your buy side liquidity or sell side liquidity, trapping retail, filling these large participants, filling their large size, and then price moves in the other direction. I personally do not believe in this. I think this sort of concept of evil market makers is bullshit. You know, I'm a big believer that price moves based on imbalance and rebalancing, where the stronger hand is in the market and where the liquidity rests, but not necessarily because one or two people want to try and take your specific stop loss. I think it's a very misconcepted thing. Either way, you know, however you want to think of an SFP and why it happens, it's entirely up to you and what you believe in. It would still work the exact same way as long as you're trading them correctly, whether you believe in one thing or another. So what is a swing failure pattern? You know, it's when you have a sweep of a key structural swing high or low, grabbing liquidity, trapping breakout traders and stops before price reverses back towards the direction it came from. Most are mistaken for every sweep of every high to be an SFP, which is incorrect. You know, they're played completely wrong by many traders. Every sweep of any high is an SFP for some people, and I'm going to show you how to avoid that. So, like I said in the previous slide, you know, many traders are caught up trying to trade every high that is swept as an SFP, every low that is swept. There are a few things I look for when trading SFPs. So, for me personally, I'm mostly a trader on BTC and ETH, so I use order flow. I use XO chart, I use footprint, so I understand people do not have access to this, but you really do know if price is going to truly break out, or there's trap traders above, trap traders below, and then you can see what happens there. I highly recommend people start to learn footprint. As always, it's a very underrated and overthought process of how to trade. It's a lot easier than most people think. If you do not have access to XO, then I highly recommend using this indicator here on TradeView. It shows you where volume was traded in each candle. It's obviously not as accurate as XO because it's not showing you the exact buy and sell orders, but it's showing you volume traded in a specific candle. So if you're seeing price trade up above a certain area and this volume indicator is showing that you have the point of control in a wick above the area that it's trying to trade, then you know the most likely the most volume is traded there. You have probably people trying to play the breakout and also sell orders coming in. So you know, it's better than just seeing the price wick and saying, okay, that's an SFP, because an SFP has to have trap traders, it has to have interest there. Okay, price, just because price wicks above another high doesn't mean it's going to swing failure pattern. It has to have interest above that high. It has to have a reason to sell off after that. So, you know, you want your SFPs to happen above key market structure swing points. So true market structure, not just any high or low that seems to look like a reversal point. You need to have a candle close completely before confirming any sort of SFP. You know, I see some people taking trades because it wicked above, but the candle hasn't closed yet. The higher the time frame of the swing failure pattern, the more conviction you have. So if you've got a big SFP on the daily, the chances are that price is going to react to that for the next few days intraday, and we're going to start to sell off to the downside if you're SFPing to the upside, or if we're SFPing to the downside, then we're going to start continuing to the upside. Something else I forgot to add to this, but an SFP is seen as a wick, not body close. You want a wick to be closed above, not a body close. If the body starts closing, then I start to think of it as a break of structure more so than a SFP. You want an SFP to look like a sharp wick like this here, rather than, and this one, rather than a full body close. So valid SFP based on structure. You can see here we're in, you know, uptrend. We have a high, high, low. So this is a valid SFP. You have price quickly wicks above and sells off above a higher high, your structured high. This is not an SFP. You're in an uptrend. This is internal structure. Okay. This is not a true SFP. You want to SFP this external structure, this true high. SFP, because it wicks above the structured high, you want to make sure that there's volume in the wick, and traders, once close back below the high, then we should start to sell off. Okay, you want it to be a true structure high or low, obviously. So in this example here, price attempts to trade above the previous structured high but fails, leaving a sell tail above. This shows aggressive sellers. You can either take your short position here once price confirms the SFP, or for this example, we do have a change of structure. So, you know, we have high, low, high, 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 low, change of structure, SFP, price attempted the trade above the previous swing high but failed. You know, wicks above, closes back below and sells off. And this is a really nice setup. SFP into a break of structure, impulsive move down, demand here. So we, even in this example, this is the indicator I was talking about. Use the volume indicator I showed you. If you do not have footprint, you can see that the POC in this candle was in the wick, so the majority of volume traded was in the wick. Enter once the candle closes and confirm the SFP, but only if you're confident of trap buyers above and good sell orders coming in. Obviously, if you want to wait for confirmation, you can enter on the retest of demand. Another example here. So price forming a swing failure pattern after being in this small range. We sweep all of the structured highs, failing acceptance above the main structured high before selling off. VPOC bar on the one hour time frame in the Pico top of the wick. If you look at the H full chart, you can see this aggressive tail. So you can see here, oops, you can see here, price goes up. We have this huge wick, and huge wick takes out all of this buy side liquidity, sweeps the high, and then we sell off. You know, you enter here once candle closes, once this H4 candle closes and confirms the SFP, but only if you're confident that you have volume in this wick, and then you see price come, you know, you see price come down and then continue selling off. So these are actual examples of a swing failure pattern. Okay, go back and study them, study SFPs yourself. I only wanted to do a small section on SFPs because I will talk about them more in later episodes with trading concepts and different market structure concepts. But you know, study this. This is what a valid SFP is. People are definitely using them in the wrong way, and you know, they're taking what they think is an SFP when really it's a break of structure and just a continuation. So they're like, you know, they're seeing PA do this and then do this, and they're like, okay, this is an SFP. This is an SFP because it tucks back below. It's not. Okay, you want to make sure that there's traders trapped, and then it should sell off. Okay, if you're trading every single SFP because it tucks back below the previous high, it's just a break of structure. Okay. Welcome to part 5, trading liquidity extended, and some just little tips about trading liquidity. This is basically the last big section for this episode. We're going to be talking about trading structured liquidity, liquidity raids before a move, weak lows and highs in a trend, valid supply and demand based on liquidity, and building a bias due to liquidity. So this is just going to be a little example of trading structured liquidity, a little concept that you might see throughout your trading days, your sessions. So for the case of the education, let's say that we see the market moving high in a bullish PA into a swing high, into a break of structure, and then we have this, you know, lower high, lower low formation. So let's go on to the next slide. We're going to see that it's forming buy side liquidity. Okay, so you know, we have sell side liquidity here, sell side liquidity here, but buy side liquidity. So what we have above here is a lot of liquidity that we want to target. So for the old swing high to be swept out, price will have a very tough time to get all the way back above there to extend all the way to the swing high, as it will have to encounter a lot of resistance in terms of old lows and short-term highs. So you know, each one of these highs is going to act as some sort of resistance, because most likely going to have liquidity above. So the off chance that price is going to do this straight from here is highly likely, unless you have a lot of liquidity to do so. So you have old lows acting as standard resistance and short-term previous highs acting as buy side liquidity. So when the market eventually presents an opportunity to move higher and finds the fuel to run all of the old highs and finally attack a sweep of the swing high, we're going to call this a high resistance liquidity run. So there's high resistance here, liquidity run, you know. So we're taking the buy side liquidity and we're going to continue trending. It might not be in this complete fashion, but for the most part it will do something like this. If we're trading a certain price action, we are not looking to go long and to target, you know, complete swing high. It's hard to take a long here and say, okay, price is going to go exactly here, because we have all of this buy side liquidity. We'll have a very tough time to clear all previous highs and take all buy side liquidity. So the preference of our target becomes previous old highs to grab buy stop liquidity, and the same applies for the reverse case as well. So now we're going to talk about what happens if, you know, instead of seeing these consistent higher lows from this swing high, we're going to see a fast imbalance to the downside. Okay, so we're going to see imbalance, and we have already covered fair value gap and how price reacts to fair value gap. So in this example, we see when price comes from an old swing high with an impulsive move, in this case it is a move down, forming imbalance in the market and not leaving much structure for buy-side liquidity to sit. Once the base is formed and we see a bullish shift in market structure on the lower time frame, we're going to look to get long. We also know it will not suffer from too much resistance to get back towards the old low, as in this low here, because it will have an easy time doing so, given the imbalance and the lack of buy-side liquidity above. So, you know, we have this shift in market structure, we have change of structure, and then imbalance. Chances are we're going to get acceptance above this high, then price is going to trend to this previous low, acting as resistance very easily, which it does so. And then also, you know, internally there's probably some buy-side liquidity here, but not enough to stop it from just performing this run, which we now call as a low resistance liquidity run. So this was a high resistance liquidity run because we have obviously high resistance, and this is low resistance liquidity run. So like I said, already studied about liquidity void and how price action moves through it. So applying the same concept with this liquidity run, you can understand how such market conditions present themselves as an easy way to go long and target the swing high. And again, you can use it to do the opposite. So if you follow my corner, you know that I post a lot about lows that look a lot like this. So what this is a liquidity raid before a move. So something I find very important is always knowing where liquidity sits and where price may want to go before the actual move you're waiting for. When I see price have an impulsive move in either direction, so for example, this is an impulsive move, we're looking for a sweep like this, okay? Structure can vary from how it builds up before the move, but most of the time if you have a build up of lows that are not swept before the move, then price will most likely revisit them. So we have this lows that are swept, so we're looking for this strength in the move, should not come back down to test it, whereas if we have lows like this, move may not be strong enough, there's a high chance price will actually revisit these lows. You know, we might have some imbalance down here, price comes, fills, so we extend, not enough momentum, comes back down, sweeps these lows, and then eventually we see the move. I think where stops and liquidity may be, not because a trend line says price will bounce there. So don't bid this, you know, think there's liquidity below this trend line. And this is what starts to happen now, is that you can tie everything we've now taught you and all of these concepts, they just sort of push into one, and over time you'll learn how to target liquidity, where liquidity sits, you know. So what this is here is, this is liquidity raid into trendline lows, and we just tie in with what we spoke about in part 2. So here's an example of Ethereum, H1 chart. So we have a volume cluster here. This was actually a H4 order block. You have the build up of lows. Price comes and it sweeps, reclaims this low. You know, we see this nice almost deviation, reclaims this low, and then we start to trend. And then at no point does price want to come back down to retest this area. Whereas if we done something like this, most likely price would have come back down, taken these lows, and then would have trended, started to trend. So weak highs and weak lows. Talked about weak lows and highs in a trend formation a lot before. You know, follow my corner again. We have a build up of structured slash unstructured lows that are really not pushing price any higher, but more so just stalling price. If you remember from the early episode, what a weak low is it does not form a new high in an uptrend, and a weak low does not form a new low in a downtrend. So these have a tendency to be taken out for price to continue in that given trend. So, you know, like I said, weak lows are when a low does not lead to a new high, so this low here has not led to a new high, this low here doesn't lead to a new high, and then you have this build up of trend liquidity here, like this, and what we're looking for is price to sweep the lows before making a new high. And same with weak highs, this high did not lead to a new low, so for this to go to a new low, it needs to sweep these highs, so it needs to come up, needs to sweep these highs, and then it will look to trend down. Okay, so usually we'll see something like this image to the right here play out. Price takes out the weak low and targets a sweep of some sort of order block / fair value gap below before continuing its designated trend. So we grab liquidity below. So we have this weak low, these weak lows building above this order block. So this is seen as inducement. We have the weak low building up, price sweeps, we reclaim the trend, and then we continue. So example here is price in an uptrend. So we have low, high, low, high, high, low. These lows did not lead to a new high. These are weak lows, not leading to a new high. Below we have a H4 fair value gap. So all this is inducement. Price sweeps into H4 fair value gap. Inducement's taken out. Price then, reclaims these sort of like these lows here, this area of support down here, reclaims, and then we see price trend from there. So sometimes price will just break down and out and continue if no point of interest to catch price. So for example, on this one, if H4 fair value gap was not below, this could just continue to sell off to the downside. The build up of lows or highs can be seen as price needing to sweep one way before continuing another. So this type of PA can be used to find when liquidity is drying up at the current prices. Okay, so we see again here, trend reversal. This low should have gone into a new high. Instead, it's just stalling here. Weak close, can't push price higher. There's no point of interest below, so this just sells off until it catches a bid. So you can also play these as continuation, or you can play this as if you're going to continue to the upside after it's swept. So finding valid supply and demand zones in terms of liquidity. So just some tips here. So in previous lectures, we've learned how to find supply and demand, but what makes them stronger is the liquidity that resides below and above them. So inducement, as we spoke of in part 3. Whenever you mark out a supply or demand zone, always keep in mind where equal lows or equal highs may be sitting. The best demand zones are found where we have equal lows above the demand zones, and the best supply zones are where we have equal highs below the supply zones. So again, just spoken in inducement part, something to always keep in mind. Similar concept applicable for double tops and double bottoms, or equal highs and equal lows, as well as to engineer liquidity before moving down. So this is just some tips for you, just a reminder that the best supply zones tend to have inducement either side of them, or demand. So building a bias in terms of liquidity. So whenever we formulate our plan of action, it's always necessary to look for obvious clean highs or lows, which are equal highs, equal lows, triple lows at bottom, triple highs at top. Reason because most of the time we have stops resting above and below them. You should know this obviously by this point in the episode. It's always safe to wait for a sweep of those highs and lows, so swing failure patterns as we spoke of, and look if the candle mitigates any imbalance or supply and demand zones, and then use our market structure concept to show in previous episodes for usual trading setups. Through this episode, you should now know what to look for if price may want to sweep a certain area. You may save yourself many stop losses because you see that price may want to take some liquidity the other side of your stop loss before continuing in the direction you want to trade. Finding liquidity really does, just come with time and the analysis of price action. So trading Bitcoin over and over again, seeing how Bitcoin performs, seeing what sort of lows are taken, seeing how price reacts to order blocks, seeing how price reacts to fair value gaps. Once you get an eye for where liquidity sits, you'll be trading other traders' stops rather than getting stopped yourself. So part 6, just a few liquidity concepts, or actually only 2 liquidity concepts, but something to keep in mind and how to trade them. So we have a target, sell side liquidity. We have these lows build up, this trend line liquidity. Like I said, before these moves, you want to see price do this. So price do something like this rather than that. Okay, we want to sweep these lows, and then we can say, okay, price will continue. So we have this is we say this is H4 and this is M30. Price swing failure patterns into sweep, creates inducement on the H4. Price comes up into the order block. We go into the lower time frame on the M30, and we're looking for our entry trigger. So we have a build up of lows in here on the M30, sweep, our normal entry, so our order block. Maybe we have some fair value gap in here, and then we continue to sell off from there. Another concept here, equal lows, high time frame order block above, supply above. We have our target. Now we're looking for our short towards the equal lows, move into high time frame order block. We have the reversal on the lower time frame, sell off down to the downside. So obviously, end of the episode, going to give you homework. Would really appreciate if everyone could do their homework on a PDF format. It makes it very easy to read. It's very easy to put together. The best way to do it is through Google Drive and use Google Docs and save it as a PDF. It's very simple to do. I can help if no one knows how to do it. So we want you to show us an example buy side liquidity without a sweep. So this is like structured liquidity. It can be any liquidity, any side of type of buy side liquidity without the sweep, any type of sell side liquidity without the sweep. Example of structured liquidity that was swept. Example of equal lows that was swept. Example of equal highs that was swept. I want you to show me a example of inducement above demand, and I want you to show me that the trade plays out. So an example of the trade playing out with inducement, and also the same for a supply. So a supply setup, so it can be a reversal setup, it can be a continuation setup, but it needs to have inducement. And find an example of a swing failure pattern. Right, so that pretty much what it does. It wraps it up for episode 3. As always, spent a lot of time on this. Appreciate any feedback. Try to make myself sound more into it. I had some comments from the last two episodes about sounding pretty tired. And that was, I would say, because I left it till the morning. This episode decided to do in the afternoon. I haven't woken up first thing. Appreciate all the support and hope it comes in help.